Hi, folks. Dan Bird here. Wednesday, October 4th. I just thought I'd do a quick midweek update because the market has been pretty volatile this week. So let's jump into it. Today, we actually had a little rally, which is nice. But Monday and Tuesday were not too good. Let me go ahead and share my screen and show you a few things. First off, let's take a look at what the market did today. And we'll take a look on the website. Right on the main page, you can see the S&P right here. Now, one thing I talked about on Sunday was this channel right here that another member alerted me to. And it's actually, there's a parallel channel starting way back here in last October when we hit the bottom. And yesterday we broke through the channel and closed below it. Almost hit the 200-day moving average and the 50% Fibonacci level. Not quite, but almost. And then today we had this little rally where it actually closed back above the channel. So what does that mean? Well, if it continues to go up, then that will be positive and might be setting us up for that end of year rally. If it doesn't, if it fails again, and even if it goes up to, say, the neckline or this resistance level right here, and then gets rejected and fails and goes back below the channel, then we might be heading much, much lower. So we just have to wait and see what happens. Now, I have been saying all along that October is a treacherous month. September is the worst month of the year, but especially the first 2 weeks of October can be very treacherous. So we have to be very careful and cautious. And the first 2 days of October did not disappoint. Today, we might be starting a little bit of a rally because everything is very oversold. Let me show you in the chart section, let me show you what the Keltner channels look like. This really tells you whether something is very oversold or not. And you can see for sure everything, you know, the S&P went right down to the bottom of this 3x average true range. And it's, you know, difficult for any market or any stock to stay there for very long. So we've got a reaction rally today. We have to see if that holds and goes back up. It might go up and get rejected again at the 21-day moving average up here. But you can see again where the support level is all the way back to February and where the 200-day moving average is. And that also happens to be a Fibonacci level. So this whole area right here is pretty solid support. So I wasn't too surprised that we bounced today. We just have to see if it's going to hold and start to trend back up. And we won't really know that. We've still got 2 more weeks of this treacherous October period before the end of year rally might get started. Might be in the 3rd or even the 4th week of October before that starts. But let me show you something from Stock Traders Almanac, which I've talked about before, and these guys do a lot of research. You can see in this case with the NASDAQ going back to the NASDAQ's inception in 1971. And this purple line here is where we are right now. We're actually a little bit beyond that. So we actually in the beginning of October went down and then came back up a little bit today. So we're roughly in that same area. But you can see historically with this blue line is pre-election years, which is what we're in right now. The market typically, you know, goes down until right at the end of October. You can see we have a little bit of a rally, which is maybe what we started today. A little bit of a rally into the middle of October, and then a sell-off in that last week. Interestingly, that's when options expiration Friday is. And then as we sell off into that 3rd week of October, that's where the end of year rally starts, right there. So it's basically been following true to form, and I expect it's going to happen again. I think we might get a little bit of a rally and then a sell-off. If we look at the S&P during that same period, S&P has actually had even deeper sell-off right now. But again, historically, sells off into the 3rd week of October and then starts to rally back into the end of the year. In fact, ending higher, hitting the high on the very last day of the year. So this is a historical trend. This one goes back to 1949. So I'm expecting that to occur. It doesn't mean it has to, certainly, but historically, that's what's typically happened. And then if we look at the 4-year presidential election cycle, by the way, Stock Traders Almanac is a great site for doing this historical research. So if you like this kind of stuff, I mean, I highly recommend checking them out. But you can see right here, we are right now, right about, well, right where these lines are, a little bit beyond that. And you can see again that it pretty much sells off again for the next 2 weeks. And then starting right in here, which is about the end of October, all the way through next year. So it's got a big rally into the end of the year, but that rally continues even into the end of next year, which is the presidential election year. So this is, again, back to 1949. This is the historical trend during an election year. So that's all good news. Most people, you probably would say, well, how could that possibly happen? Because the economy doesn't look too good. We might be in a recession. Yeah, we might be, but always remember the market, the stock market is not the economy. It will move well in advance of the economy itself. So yes, we might get a recession, and that might account for this little downtrend right here, probably in Q2, Q3, which is about when I think we'll probably have one. But it'll be short and shallow, and then we'll take off again into the end of the presidential year. Again, not to say that this has to happen. It doesn't. The market can do anything it wants. But this is the historical trend going back quite a ways. What else do I want to show you here? Something that's really interesting. I put together this 30-year fixed rate mortgage chart. I've been seeing some folks talk about interest rates going up. Rick Santelli the other day was talking about 13% on the Fed funds rate. I doubt that we're going to get there. And he was using comparisons back to 1981, but we're not in 1981. This is much different right now. But this 30-year fixed rate goes back to 1990. And it's interesting. The black line is 30-year fixed rate mortgage, right now at about 7.25%. The light red line behind it is the 10-year Treasury yield. And notice how it trends pretty closely with the 30-year mortgage. In fact, most of the time, the majority of the time, the 10-year yield leads the 30-year mortgage, except right now. Right now, the 30-year mortgage is actually leading the 10-year Treasury yield. So what does that mean? Does that mean the Treasury yield has to go much higher to catch up? Or does the 30-year fixed rate need to come back down to catch up, to reflect what normally happens all the way back to 1990, 33 years worth, basically. And then the green line right here, the light green line, are the Fed rate hikes, or Fed rate, let's call it. You can see here in 2006, they kept it higher for longer, for a whole year. They kept rates high. We are almost right about, we might be a little bit higher than that right now, but we're right about that same level that we were in 2006. So in 2006, again, they said higher for longer. They kept it there for a year. Fed is talking about that again. So we'll see if they do that again. But you can kind of see how that maps to the 30-year mortgage and the 10-year Treasury yield. I put the recessions in here too, so that you can see them. And one thing that's interesting, every single time the Fed starts cutting rates, every single time, that happens just before a recession. In this case, 6 months before. This case here, about 5 months before. And this one here, about 7 months before. But every single time, even if they do higher for longer, the recession doesn't happen until after they start cutting. So that's interesting to take a look at. By the way, all the charts that I use are on my website. So if you ever want to look at those, they're out here. The other thing that's interesting that I wanted to show you real quick before we wrap up today, and then at the end, I'll talk about where I think we might be headed. This market bias matrix that I put together that I'm updating now every day. And it basically groups the market into categories, indexes, sectors, indexes, sectors, industries, intermarket relationships, commodities, metals, and currencies. And then I look at a short-term, medium-term, and long-term bias of what each of these is doing. And I change this based on what they actually are showing. So you can get a sense for what the market is doing right now. You can see on a long-term basis, it's actually bullish. But in a short-term and medium-term, it's pretty bearish. And I think everybody would agree that's probably the case right now. So two things that I've done on this that I want to track, and I don't know how this is going to work out, so I'm really curious to see what happens. But one thing I did was I put the three indexes, the S&P, the NASDAQ, and the Dow up here in the top together with, and kind of bracketed them up here. And the thing that gave me the idea on this is watching a webinar today from Stock Traders Almanac, where they have a buy signal using the MACD, using an 8 and a 8-day moving average and a 17-day moving average. And when they get a crossover or a buy signal on all three indexes, so it has to be all three. It can't just be one or two. But when they get that buy signal after October 1st, they say that's when the end of year rally has begun. So I'll be watching that from them to see when they give it. But I was thinking I could maybe do the same thing here and look at the short-term bias, which basically uses a 5-day and a 21-day. They use an 8-day and a 17-day. So I'm using a 5 and a 21. And when each one of these three turn bullish, they all have to turn bullish, then that's the signal that the end of year rally may be starting. So we're going to watch that and see what happens. You can click on any one of these over here to look at the actual chart. And the S&P actually shows how I calculate these, how I figure these. So the pink line is a 5-day moving average. The blue line is a 21-day. The red line is a 50-day. And then the gray dash line is a 200-day. So a short term is when the 5-day crosses the 21. So we actually got a short-term down signal back here in the middle of September. The medium term is when the blue line crosses the red line. So the 21-day crosses the 50-day. And we got that medium term bearish signal in the third week of August. And then finally, when the red line crosses the gray line, the 50-day moving average crosses the 200-day moving average, that's when we would get a long-term bearish signal. We right now have a bullish, long-term bullish signal that happened way back here in February, beginning of February. And you can see the market has been going up since then. It's been coming down, certainly, but we don't have a long-term bearish signal yet. So that's the way those things look. You can click on any one of these to look at the individual charts. So that's the first thing that's going to be interesting to watch on this particular one. The other one that I thought was really interesting are these intermarket relationships. Now, these intermarket relationships are the relationships between growth components and value components, or defensive sectors, defensive components. So aggressive versus defensive. And you would think that if the market was heading into a long-term downtrend, that most of the big traders and investment houses would be transitioning their portfolios from aggressive into defensive. That's what happened in December of 2021, even as the market was hitting all-time highs. The transition was moving from these aggressive sectors all through December into the defensive sectors, which gave us the signal that the market was about to start going down, which it did the whole year of 2022 until October. So the interesting thing about this is that this right now is the only category that has 100% bullish signals. 100%, short-term, medium-term, and long-term. And if I look at each of these, we can see this is discretionary versus staples. You know, these are all moving up. The next one is the QQQ versus the SPY, or the NASDAQ versus the S&P. Again, these are all bullish configurations. Transportation versus utilities. This again is a bullish configuration. All three of them are bullish. In fact, the medium term just went bullish on this one. Russell growth versus value. So growth versus value, meaning that if it's trending up, that means growth is outperforming value. Again, these are all bullish configurations. The next one is the Dow Jones large cap growth versus large cap value. Also bullish. In fact, both the short term and the medium term just turned bullish. The next one is mid cap growth versus mid cap value. Again, all bullish. And this one here is small cap growth versus small cap value. Again, all bullish. And that's it. So all of those, 100%, every single one are bullish. If the market was getting ready to go into a long downtrend, I would think that these large investment houses would be starting to transition the other way, transition their portfolios from growth into value or from aggressive into defensive. But you can see some of these have just begun to become bullish. In fact, this just turned 100% today. So I thought that was really interesting. We'll continue to watch it and see if it pans out, if this is maybe a clue of what's going on. But I think that the market is getting ready once we get through these next couple of weeks, which are going to be choppy. I've been saying this for quite a long time. I recommended not getting into any new positions until the end of October and then see if the rally has started. We now have some ways to identify if the rally has started. So I'll let everyone know in my newsletter if that occurs. But it'll be really interesting to watch all of this as it pans out. So that's it for today, midweek update. What I think will probably happen if we go over and look at the NASDAQ on the main page, you can see the NASDAQ also is right back into this support resistance zone right here. So it still really hasn't broken out yet. But with this big gap down after the Fed meeting, this big gap down, this potentially is setting up something in technical analysis called an island bottom. If this were to gap up on the other side and start to move higher, that would leave this whole island down here with gaps on both sides. And that is extremely bullish if that happens. Hasn't happened yet, and it doesn't mean that it's going to. Doesn't need to happen. But you can see all the moving averages now are still in bearish configurations over here other than the long-term one. So these, of course, need to move up as well. But what I think will happen is the next couple of weeks will be choppy. I think the third week or towards the end of the third week of October, probably after options expiration, the market would begin its end-of-year rally. One other thing that I learned from Stock Trader's Almanac today is that legally, the IRS requires ETFs and mutual funds to confirm their portfolios for the last 10 months. And they have to do that by the end of October 31st. So that's one of the reasons why the market starts to trend higher in October. October is known as the bear killer, but it usually doesn't happen until the second half of October. So we'll see what happens and continue to watch it. Anyway, that's my midweek update. Hope everyone is doing well. Get your lists ready. I know a lot of people still think the market is going to crash, go way down, and it very well might, but I still think that we're in for an end of year rally. Okay, so that's it. Thanks, folks, for watching, and I'll talk to you soon.